This video will be on Chapter 6, Inventory and Cost of Goods Sold. The learning objectives: number 1, show how to account for inventory. Number 2, apply and compare various inventory cost methods. Number 3, explain and apply underlying US GAAP for inventory. Number 4, compute and evaluate gross profit margin, percentage inventory turnover, and days inventory outstanding. Number 5, use the cost of goods sold model to make management decisions. Number 6, analyze effects of inventory errors. So up to this point, we've been focusing on service companies. Service company examples would be car wash, accounting services, cleaners, pretty much just any kind of service that you can think of. And so most of our accounting concepts have been really related to service companies. In Chapter 6, we start to look at how a merchandising company might differ from a service company. In other words, there are some things that you're going to actually account for in a merchandising company that you don't in a service company. And so immediately we'll take a look at a financial statement of a service company and compare it to a merchandising company. As an example here, Century Real Estate, that's a service company. You see you have service revenue and then you have expenses. If we go to Under Armour Incorporated income statement, we can see that we've added to the income statement what's called the cost of goods sold. That's something that did not exist when we looked at the income statement of a service company. Cost of goods sold is added, and the computation of what is referred to as gross profit. Gross profit equals sales minus the cost of goods sold. And then from then on, operating expenses look very similar to expenses listed on a service company. So here's what it says. Merchandisers have two accounts that service entities do not or don't. As an example, the cost of goods sold, that's on the income statement. We just witnessed it. We looked at it. It also is referring to another account that you will see on a merchandiser that you will not see on a service company, and that is inventory. And so if we go to the next slide, we'll see that the balance sheet, which contains all the assets, on a service company excludes inventory because a service company doesn't have any inventory. It's just selling a service. However, in a merchandising company, such as Under Armour, you would see an account called inventory, which represents the cost of goods that are purchased for resale and that are still in inventory. They still are on hand. They have not sold yet. Now, having said this, we know that there's a direct relationship between the inventory and the cost of goods sold. So assume Under Armour outlet has in stock 300 men's fleece hoodies that cost $30 each. The store marks each hoodie up by $20. So it pays $30, but it sells it for $50 and ends up selling 200 of the hoodies for $50 each. So we know that initially, when the inventory was purchased, before you do anything, you're going to have in inventory 300 fleece hoodies at $30 each. So what's going to actually go into inventory is 300 times 30, which is $9,000. Initially, you would expect to see right when they purchase it, you would expect to see inventory at $9,000. Now, if they don't sell anything, that's what's going to stay there, but it tells you that they actually sold 200 of those 30. When you purchase the hoodies, they first go into inventory, but as you're selling them, they're taken out of inventory and put into the cost of goods sold. The cost of goods sold, since we sold 200, the 200 times the 30, the cost of the goods moves to the cost of goods sold. 200 hoodies times $30 is $6,000. Again, initially when they purchased it, all of them, if they purchased all of it at the same time, 9,000 went into inventory. But then once it's sold, it's taken out of inventory. That cost is taken out of inventory and put into the cost of goods sold. Why? Because, as the name suggests, that is the cost of each item that was sold. So they sold 200 hoodies, and they purchased it originally for $30 each. That's going to go into that cost of goods sold account. Now, if you think about it, they purchased $9,000 worth, of which $6,000 is now in the cost of goods sold and $3,000 remains in inventory. The example here says that 200 of them were sold for $50 each. That was not relevant as it related to inventory or the cost of goods sold. However, it is relevant as it relates to sales. So they sold 200 at $50 each. Well, 200 times 50 is $10,000. So you would expect to see sales of $10,000. That would be at sales revenue. The cost of the goods is the same 200 hoodies, but the cost was only $30. So $10,000 was sold and $6,000 was paid for that what was sold. The next slide shows that the cost of the inventory sold shifts from the asset is inventory, to the expense. The expense is the cost of goods sold when the seller delivers the goods to the buyer. So the money first goes into inventory when you buy it, and as you sell it, it's taken out of inventory and put into the cost of goods sold. So this is what is sometimes confusing for most, the sales price versus cost of inventory. Sales revenue is computed by taking the sales price of the inventory that is sold. But let's make it very clear, it's what was sold and what it was sold for. So this is going to impact either cash or accounts receivable, cash if it's sold for cash, or accounts receivable if it's sold on account. And then it's going to impact sales revenue. So that's it. That's where the sales price is used to compute the sales revenue. The cost of goods sold is based on the cost of the inventory that is sold. How much did you pay for it? And that's going to be computed by taking the number of units sold multiplied by the cost per unit. And then inventory is the same as the cost of goods sold in the context that you're still using the cost of the item. The difference is, though, what you're going to be computing for inventory is the number of units that are still on hand multiplied by the cost per unit. Here's an example of what you would expect to see if you were looking at Under Armour Incorporated, the balance sheet. And specifically under the balance sheet, you would see inventories and a dollar amount here. Now this appears to be, I'm going to guess, in millions, 917 million. That's what I would guess. It appears they also have an income statement, just the area that we're looking for, that we're focusing on, where we have net sales revenue, which in this case is $4,825,000,000, and the cost of goods sold is $2,584,000,000. So that the gross profit is the difference between sales and cost of goods sold, can be computed as $2,240,000,000. Continuing on with discussing the sales price versus the cost of inventory. The number of units of inventory, we have to take into consideration some things that may not be so obvious, especially when we're first learning. So the number of units of inventory would be determined from the accounting records. It is evidenced by a physical count at year end. So if you've ever worked for any merchandiser or a company that sells items, you know that at the very least once a year, you are taking a physical inventory of what you have of all your merchandise. Now, what gets a little bit confusing is consigned goods. There are retailers out there that don't really buy products. They maybe just have a storefront, and they put things in their store that are on what's considered as consignment. And the merchandise is there for people to come in, and for the buyer, it almost seems as if they were shopping at a retailer. But there are some companies out there that do not buy the product, they just show the product in their stores. So consigned goods are not included in the inventory of the company, of the retailer, because they don't own the inventory. The product is only paid for after it's been sold. Now, if your company puts product out on consignment, in other words, you send your product to a merchandiser and show it on their floor, if they haven't paid you for it, it's still not their product, it is still your product. So you're going to make sure that even though you may have product out on consignment, it is on your books as your inventory. And then the other tricky thing that we've talked a little bit about already is the goods in transit. And whenever something is in transit, it really kind of depends on the shipping terms, which was what we mentioned to you before. The terms can be FOB shipping point or FOB destination. And what this means, if you recall, FOB shipping point means the exchange or the ownership changes hands when the goods leave the seller's ship dock. FOB destination says, no, the exchange does not take place until the goods are delivered to the customer. So let's assume this cargo ship is coming from Japan. The question becomes, when does the exchange take place? When do I include the inventory that's in this cargo ship on my books? And the answer is, it depends. If the shipping terms, if the terms associated with buying the goods, the shipping terms are FOB shipping point, then the exchange takes place here. And in that example here, if it's shipping point, then the ownership transfers here. Now, if something happens to the ship on the way over to California, I guess I have to be clear. I'm the California company buying goods from Japan. And if something happens to this ship on the way over to California, then it doesn't matter. When I get this invoice, I got to pay for it. That's mine. And it doesn't matter that this is, as soon as it leaves the dock from Japan, I've got to include that as my inventory, even though it's not in my physical custody. It really is in my physical custody. I hired a freight company to take care of this. If something goes wrong and that ship goes down for whatever reason, then I have to put in a claim with that carrier. Now, if the terms are destination, then the exchange takes place here. So in this example here, the California company does not have inventory until the product reaches its destination. If something happens to the ship on the way, well, the Japanese company is the one that's going to have a problem. And the Japanese company can bill me forever. I'm not going to pay it because I never got ownership of it. By the same token, let's go back to shipping point. If the exchange takes place here, if the terms were shipping point and that plane and that boat goes down, then Japan sends me an invoice. I have to pay that invoice because I took ownership at shipping point. So that's interesting, but what's most important in the context of what we're learning here is once this boat leaves the dock, the shipping dock here, and if the terms are shipping point, then this is my inventory and I have to include it on my books. If the terms are destination, it's not mine until it arrives on or at our dock. Now, the cost per unit really creates the challenge with inventory. On the surface, it seems, well, that kind of seems like a pretty easy type deal, right? Why is this such a complex situation? Well, it's not a complex situation if your price never changes. But the reality is prices do change. And so with differing prices, we have to make a determination of what is the cost of the inventory that still remains and what is the cost of the goods that actually have sold already. And if we bought the same product at different prices, that creates a challenge for us. Now, the challenge starts with what type of inventory system are we going to be using? And there are two that we will discuss in this class. The first inventory system is referred to as perpetual inventory. The characteristics of perpetual inventory systems include used for all types of goods. The perpetual inventory system keeps a running record of all goods bought, sold, and on hand, And the perpetual inventory system is inventory counted at least once a year. Okay. When you think of perpetual inventory systems, I want you to think of technology. Because in today's world, the only way that that works is if you're using technology. And when I say technology, I'm thinking about barcode systems. So that when the product arrives in the back of the retail store, they have scanners that are scanning the product in that is updating the inventory system immediately. That's perpetual. Things are updated on real time. As the products are being sold and going out the front door, the customer is bringing the product to the cashier scans. As the product is being scanned, it's updating the inventory records again. Real-time updates. Keeps running record of all goods bought and sold on hand. So when you think of perpetual inventory system, think of technology. Now, a periodic system does not use technology. And that kind of seems a bit weird, but there are circumstances where it actually makes sense, or it may be nearly impossible to use technology. Periodic system is used for inexpensive goods. A periodic system does not keep a running record of all goods bought, sold, and on hand, but instead counts its inventory at the end of the year. And in that periodic system, we're learning how to compute inventory and the cost of goods sold. So focusing on perpetual, we're going to be recording transactions in the perpetual system that would include when a store makes a sale, 2 entries are needed to record the sale. The first is going to debit cash or accounts receivable, cash if it's sold for cash, accounts receivable if it's sold on account, and then credit sales revenue. So we debit cash or accounts receivable and credit sales revenue. In addition to that, we're going to make a second journal entry, and that journal entry is going to debit the cost of goods sold and credit inventory. So by debiting the cost of goods sold, we're going to recognize the cost of the goods that were sold, and then we're going to reduce our inventory for the credit against inventory. So let's take a look at a perpetual inventory system and how the recording and reporting of inventory will take place. In this example here, for number 1, the company purchases $560,000 of inventory. This is the purchase, this is the cost of the inventory. So naturally, the purchase of inventory on account, that's specific, it's on account, it wasn't for cash, it was on account, will be a debit to inventory for $560,000 and a credit to accounts payable for $560,000. So if we use T accounts, inventory will be debited for $560,000. Call this journal number 1. And then accounts payable is going to be credited for the same. So assets increased by $560,000 and liabilities increased by the same $560,000. Now when it's sold, the transaction for the sale is actually going to impact 4 accounts, not just 2. First, you're going to record the sale. In this case, we sold it for $900,000. Now, it doesn't appear we sold all of the inventory, and I'll show you how that makes it obvious at the end. So now the second journal entry is going to be the sale. The sale is we sold it for $900,000. And we sold it on account, so it's going to be a debit to accounts receivable for $900,000 in sales revenue. This is the first part of the sale. So we'll go ahead and put $900,000 as a debit to the accounts receivable, and as a credit to sales, we'll put a credit to that account. So now we have our debit, accounts receivable, $900,000, and a credit, $900,000 to sales revenue. But we're not done with this journal entry. As part of the sale, we also have to update the cost of goods sold and inventory. So in this case, we didn't sell all the $560,000. We sold a good part of it, but not all of it. So we sold, of the original cost, that $900,000 that we sold cost us $540,000. That's what we paid for the inventory. So now we need to update both the cost of goods sold and inventory. The debit is to the cost of goods sold and the credit is to inventory. So you'll see the flow here. It'll be really obvious now. We're going to debit $540,000 to the cost of goods sold, and we're going to credit $540,000 to inventory. So the cost of the inventory was first categorized as inventory, but as you sell it, it's taken out of inventory and put into the cost of goods sold. Now in this example here, it appears we had a beginning balance, so let me make sure. Let's move that down. And it appears we had a beginning, even before we purchased that $560,000, we had as a beginning $100,000. So the way it works is $100,000 was in inventory to begin with. We purchased 560, we then sold 540, and our ending balance is now 120. The 540 was taken out of inventory and pushed to the cost of goods sold. Just remember that none of this has anything to do with what the sales price was. The sell price was all here. Accounts receivable, sales revenue. And this is what I drew up on the spreadsheet, so you can review that. If that's all we have in play, if this was for an entire period, let's say a month or even a year, depending on the size of the company, then you would expect to see on the income statement, and this is just showing a partial, you would expect to see the sales revenue less the cost of goods sold of 540. So your gross profit is going to be 360, the difference between sales and the cost of goods sold. The ending balance on the balance sheet is going to show inventory, and it's going to show it at $120,000, which is what you're seeing here as the ending inventory balance, and it's also what we showed here on the spreadsheet that I put together for you. Now the question, again, sometimes things seem really obvious, but then as you get deeper into it, you find out it's not as easy as we thought. The question often is, well, what costs do you include in your cost of inventory? Well, there's no question. The purchase price of the inventory, that's definitely going to be inventory. And so that's all we've really kind of looked at right now. Okay, just the cost of inventory, that goes in inventory. But no. Sometimes you're going to have some other things that we have to account for in our inventory. So whatever it costs us to have something delivered, if we're paying for the freight, then that cost is going to be added to inventory. If we had some returns, some things that we purchased that we didn't like, we can deduct that from our purchases. And so we have what's called purchase returns. We can have purchase allowances. Let's say they give us a discount of some sort. We can take, a company will offer us some type of a reduction in our price or an allowance of some sort. For whatever reason, it could be volume discount. And then finally, we have our purchase discounts, which is the same as a sales discount, except it's from the purchaser side. And this would be if we pay it early, we can take a discount. So remember those terms, 2%, 10, net 30 as an example. They're going to offer us 2% discount. And if we take that discount, then we've got to show that purchase discounts as a reduction of inventory. So after we take all of this into consideration on our costs, we know that our net purchases of inventory is $560,000. So that's where we got the purchase of $560,000 that was a couple of slides back. So as an example here, we've got some journal entries to record the purchase of returns for merchandise that cost $500. If we actually return the merchandise, we're going to debit the accounts payable because we don't owe as much as we once thought we did. We'll debit it. And then we'll credit the inventory. That reduces inventory for the 500 in this example. So when we're talking about purchase discounts, let's say the original purchase amount is for inventory was 1,000 units at $1 each. That would give us a debit of $1,000. That's debited to inventory. the credit is to accounts payable. So this is what we've seen before, a debit to inventory and a credit to accounts payable. But now, if we get a discount for an amount that we've paid, let's say within their payment terms, let's say we get a discount of 2% within 10 days, and we do in fact pay within the discount terms, then we're going to go ahead and credit cash, not for the $1,000. We're not going to have to owe or pay $1,000. We're going to credit cash for $980. That's 98% of the $1,000. That's with the 2% discount. We're going to debit accounts payable for $1,000. Well, the reason why we're debiting $1,000 is because we credited it for $1,000. Even if we take a discount for $980, we don't owe the $1,000 anymore, so we've got to remove that. So this debit offsets that credit. Now there's a difference. The difference is $1,000 and $980. The difference is the $20. That's the discount. So that discount then is credited against inventory. So we have to remember and understand that the cost of any asset, such as inventory, is the sum of all costs incurred to bring the asset to its intended use. Remember that, because we're going to use that definition later on when we're talking about the purchase of fixed assets. But the cost of any asset, such as inventory, is the sum of all the costs incurred to bring the asset to its intended use, less any discounts. And so when we're talking specifically about inventory, the costs might include the purchase price, the freight in, the insurance while in transit, fees, taxes to get inventory ready to sell, and less any returns, allowances, and discounts.